Hello, everybody. Let's just give it a few minutes or even a minute for everyone to kind of trickle in to be attending. Hope everyone's having a good morning here. All right, let's go ahead and get started. It's about 11:01. Thank you everyone for joining us today for this month's webinar, deep dive into mutual funds and exchange traded funds. I was kind of surprised by how many people signed up because I thought this would be one of the more boring or dull topics, but for those who kind of are interested in it, could be really informative. But we had a pretty good turnout in terms of people who were interested in attending. So we're really happy to see that. Jeff and Jamie are both on as well as panelists, so they'll standing by if you have questions. They'll help put them in the queue and make sure we address them at the end of the presentation. And just as a reminder, you can put those questions into the Q&A. So if you hit the Q&A box at the bottom, you can type in your questions and then we'll be able to see them there. Hopefully everyone can hear my voice, see my screen, and see my face. If you can raise your hand, if that's a yes, just so I know we're good to go. Thank you. All right, I think it looks like a lot of people are raising their hands, so we should be good to go. So let's go ahead and get started. Honestly, this presentation or this webinar on mutual funds and exchange funds could be, we could do this the entire year. It really is one of those subjects where, we can scratch the surface, but the deeper down we go, there's more and more and more there. So we will do our best to give you a very comprehensive dive into mutual funds and exchange traded funds. And then if there's more information you want or want to hear more about, just let us know. So quick disclosures. We are a registered investment advisor and our services are only offered. Advisor services are only offered to clients or prospective clients where 4J is properly licensed or exempt from licensure. It's contents for informational purposes only. Past performance is not a guarantee of future returns. Any securities mentioned in this webinar do not constitute a solicitation to buy or sell. Investing involves risk and possible loss of principal capital. No advice may be rendered by 4J unless a client service agreement is in place. All right, let's get started. So here's what we're going to cover today. What is a mutual fund? What is an exchange traded fund? How are these vehicles taxed? This is something every year clients have questions on when they get their 1099 from Fidelity. So I want to spend some time really helping you understand how these vehicles work, how they're taxed, and how it affects you. We're going to talk through the criteria that should be considered before selecting these funds, how we analyze and use these investments in the portfolio, pros and cons of these vehicles, and then diversification and asset allocation. So this, just to give you a sense as to the size of this market, as of the end of 2021, US-based mutual funds had $27 trillion in assets. Most of you have mutual funds, whether it's in your accounts with us, or if anyone has an outside 401k plan or an IRA, most likely there's going to be mutual funds in those plans. But the point is, this is a massive market. 27 trillion is I think a little bit bigger than the entire size of the U.S. economy. So there's a huge amount of money in these, and for anyone who is employed or close to retirement or been a participant in a 401k plan, they're going to have mutual funds. So it's very relevant to a lot of people. Exchange traded funds are still very large. They have a large amount of assets as well, but they're a little bit newer to the scene. So they have $7.2 trillion in assets. So you combine those and you're well into the $30+ trillion range in terms of assets. And you can see below kind of as a percentage of household ownership, number of individuals in the US owning mutual funds, 108 million, right? There's only 335 million people in the US. Percentage of households owning funds, 48%. So the point is, this is very relevant to a huge swath of the US population. So the more we can know about it, the better. So what is a mutual fund and what is an exchange traded fund? So let's start with the mutual fund. So mutual funds are structured as pass-through entities. And what mutual funds are is, think of them as a vehicle, right? A fund that pools investors' money and invests that pooled money into either stocks or bonds or other financial assets. When you invest in a mutual fund, you are a shareholder of that mutual fund and you receive a pro rata share of that fund's income and gains and losses. In addition, every mutual fund by prospectus has to have a defined investment objective, meaning they're investing for growth or for capital preservation or for income or for growth in income. And they also have a fiduciary obligation to invest according to that objective, okay? When people talk or you look at your mutual fund and how it's doing, the mutual fund performance is going to be a direct function of the performance of the underlying securities, right? The stocks, the bonds that it owns, and how those underlying securities do over time, right? That's going to be a direct, it's going to feed directly into how that mutual fund performs over time. So exchange traded funds are similar in that they are pooled investment vehicles. So that's very similar to a mutual fund. But unlike mutual funds, where you're trading directly with the mutual fund and they're priced at the end of the day, once a day, exchange traded funds actually trade on the exchanges like the New York Stock Exchange, just like stocks do. So ETFs can be bought or sold throughout the trading day, unlike mutual funds, which only price at the end of the day. An ETF, like a mutual fund, is a single fund which represents many underlying securities, right? So even though you might buy an ETF on the exchange, unlike an individual stock, which is just obviously representing that one company, an ETF could have 100, 500, 1,000 companies that are part of that, that are underlying that fund. And most often, ETFs track a particular index or market sector, or even industry, like a sub-industry, or some sort of commodity or precious metal. So the majority of ETFs, okay, 90+% are what are called passive, meaning they're only trying to track or mimic a particular market sector, an index like the S&P 500 index or the NASDAQ or some commodity, right? That's it. ETFs can contain all types of investments, right? So there can be ETFs that just track stocks. There can be ETFs that only are tracking commodities, ETFs that only track bonds. Some offer US only holdings, others are international, right? So that's also similar to a mutual fund. So you can have a US ETF that just tracks US securities. You can have an ETF that tracks international securities. You can have an ETF that does both. But I think the big differentiators are ETFs can be sold throughout the day because they trade on the exchange like a stock. And secondly, the big difference is that an ETF is almost always going to passively track a particular market segment, index, or commodity or precious metals, whereas a mutual fund, they can be passive and track things the same way. But many times a mutual fund is run by a portfolio manager where they're actively deciding what they want to buy and what they want to sell, right? They're trying to outperform the market, or at least have a performance where there's less risk than the overall market. So let's highlight kind of specifically here some of the differences between them. So mutual, and a little more technically. So mutual funds are priced based on the net asset value of the fund at the end of each day. The NAV is a function of the increase or decrease of the underlying securities prices over the day, as well as any distributions that occur from the fund to its shareholders. We'll come back to that when we talk about how these things are taxed. Mutual funds also can have share classes which result in different cost structures. There's an A share, a B share, a C share, an advisor share class, there can be retail share classes, institutional or I share classes. And basically those are all, you could have the exact same holdings and the exact same fund, but because of the share class that's attached to it, the expense ratio of that fund or the load of that fund will vary. So A shares have a front end load, B shares have a back end load. You can buy no load funds as well. All of the funds that we purchase on behalf of clients are either going to be institutional share class or no load funds. We have a fiduciary obligation to purchase the lowest possible cost mutual fund share class on behalf of clients. There are, though, there are options throughout the financial industry. If you work with other financial advisors that may work on a brokerage basis with mutual funds, where they will sell A share, B share, C share. And it's important to note that the share class that they're advising or recommending to you will dictate how they, as the advisor, get paid. So it's very important that you understand the A, B, and C share class when you're working with a broker who is selling you a mutual fund, okay? Exchange traded funds, we talked about this, they trade throughout the day and the price changes throughout the day, just like individual stocks. If you're buying the shares of the ETF, you're buying them from other investors selling those shares on the exchange. Whereas if you're buying shares of a mutual fund, you're actually only dealing with the mutual fund itself, not other investors. The underlying securities in a mutual fund and ETF can be similar, but the entities are just structured differently. And a good example of that would be, you could have a mutual fund that's a passive mutual fund that tracks the S&P 500, and you can have an ETF that's a passive ETF that tracks the S&P 500. And if you were to look at the performance of the mutual fund and the ETF that tracks that same underlying index over a 10-year period, it's going to look like they're right on top of each other, right? The difference is the only difference would be is if you wanted to sell that mutual fund, you could sell it and you'll get the price at the end of the day. And if you wanted to sell the ETF, you could sell it, 11:13 a.m. and you would get the price at that point in time. So there's a little bit more flexibility and liquidity with the ETF in terms of getting in and getting out, but you can largely create the exact same effect in terms of what you want from an investment standpoint over a long period of time, based on that example I just gave, right? My point is, over a long time period, you can essentially mimic the performance. It doesn't matter whether it's a mutual fund index fund or an ETF index fund. They're going to look exactly the same over a 5, 7, 10-year period, even a 1-year period. Okay, so I'm going to spend some time here because this is often, we have lots of questions on this. So how are these vehicles taxed? The first thing to remember is if you have mutual funds in a 401k or an IRA or a Roth IRA, any sort of retirement account, you don't have to worry about how these vehicles are taxed because it all occurs in that tax deferred wrapper, right? Mutual fund pays out income or distributions. As long as you don't withdraw it out of that retirement account, you're not going to be taxed on it. So you don't really have to worry about how these vehicles are taxed when you're in the context inside of a retirement account. So really what we're talking about with the remaining bullets is when mutual funds are owned outside of retirement accounts, like in brokerage accounts, individual accounts, trust accounts, things like that. So as I said before, mutual funds are pass-through entities, meaning any capital gains or losses, as well as income earned, gets distributed through to shareholders. Distributions you receive from mutual funds are generally considered investment income on your tax return. We'll talk about this in more detail in the next slide. Exchange traded funds most of the time are passive. So there's very minimal pass-through of capital gains or losses because they're not buying or selling stocks or bonds throughout the year. They're just essentially buying all of the securities in the particular index they're tracking, and then it's just they're holding it. So the only income you would get from an ETF would be the dividends or interest the ETF generated from its underlying holdings, right? So if you think of an ETF that tracks dividend paying stocks, you'll be taxed, but only to the extent that the underlying holdings in that ETF pay dividends, you'll get a 1099 DIV for that. The other thing to keep in mind with mutual funds, and this is where it gets tricky, is there's two things happen, two potential tax pieces you can face. And it's because you own the mutual fund and you bought into the mutual fund at a particular price. And then you're going to decide how long you want to hold that fund and then when you sell that fund, okay? So if I bought a mutual fund for $10 and 3 years later I sold it and it was worth $13, you know, let's just say my cost basis was 10, I sold it for 13, I'm going to have a long-term capital gain of $3 for every share I own of that mutual fund, right? The 13 minus the 10. But in addition, over that 3-year period, let's say the mutual fund, right, had interest that it generated and passed through to me, or dividends that generated and passed through to me, or sold stock that it had a gain in, that would get passed through to me in that year. And so you will also incur taxes from the underlying activity of the mutual fund itself over the course that you own it. And that is super, super important to understand, that the duration that you've held a mutual fund, it's independent from the taxes you face from the mutual fund's handling of individual securities in its portfolio. We're going to come back to this because this is, in my opinion, one of the most important parts of this webinar, is really understanding that part, because a lot of individual investors, I don't think, fully appreciate that and are surprised. So how are these vehicles taxed? Let's continue here. Common point of confusion from clients. I did not take any money out from my account, so why am I paying taxes? Fair question. And the reason is that mutual funds almost always have some activity, some buying and selling, as well as income that is generated from its underlying holdings. That income or capital gain is distributed to you as the shareholder. And many times the default is to reinvest those distributions back into the funds. But guess what? If they send out that money and it's deemed, you know, income from dividends or interest or capital gain, that's a taxable event to you, okay? Even if you reinvest that money back into the fund, it doesn't matter. That increases your cost basis because you're paying tax on those distributions and then you're adding it back, but it's still an activity of the fund. And as a shareholder, it's getting passed through to you as income, and that's why you pay taxes on it. Now, those distributions from mutual funds can be categorized different ways. Dividends from stocks can be taxed either as qualified, which means they're taxed as long-term capital gains, or if they're non-qualified, they will be taxed as ordinary income. The interest that's generated and passed to you from bonds can be taxed as ordinary income if it's investment-grade corporate bonds, or it can actually be tax-free, at least on the federal level, if it's municipal bonds. And thirdly, capital gains, right? If the fund sells securities that increase in price, and how that's taxed depends on how long did the fund own that security. If it was more than a year, it'll be taxed as long-term capital gains. If it was less than a year, it'll be taxed as short-term capital gains, which is also will be taxed as ordinary income. Short-term capital gains are taxed as ordinary income. So one thing that is important to look at is what is the turnover rate of the mutual fund each year? And that turnover rate, right, how often they buy, they kind of turn the portfolio over, can have material tax consequences to you as a shareholder. And remember, if you sell the mutual fund, you'll be taxed in the difference between the price of the fund at purchase, excuse me, the price of the fund at sale and your cost basis in the fund. So just to kind of come back to this, let's say you bought a mutual fund, right? You didn't do anything, you're holding it, But let's say you've owned that mutual fund for, let's say you bought it in June, but let's say the mutual fund during the course of that year sold an underlying stock that they've owned for 20 years. Come the end of the year, that distribution gets sent out as a form of a capital gain. And my question to you would be, well, you've only owned the fund, let's say, for 5 months at that time. Do you get taxed on something that they sold from a security that they own for 20 years? The answer is yes. The answer is yes. So it's something to be aware of, especially this time of year where we're getting into kind of the end of the year. If you buy into a mutual fund now outside of a retirement account, you might be signing up for taxes that you may want to just wait until after they do their distribution for this year, so that you're not buying in and then getting taxed on activity that you weren't even in the fund for. But that's kind of that's one of the disadvantages we'll talk about with mutual funds is this the way they're handled from a tax perspective. So hopefully that's helpful. We'll get this slide edited and corrected for that bottom bullet, but hopefully this is helpful. But I did want to spend a decent amount of time here because it's really important, and there's a lot of confusion oftentimes that occurs as to why people are being, why are my taxes higher this year, or why am I being taxed if I didn't take anything out? What criteria should be considered before selecting funds? So we're going to go through kind of a number of criteria here that we look at and we think anyone should look at when they're evaluating whether to purchase, to buy into a mutual fund or an ETF, but particularly a mutual fund. So the first is the investment objective, right? What is your investment objective, and how does a particular fund fit in with your overall investment mix? So what's an example of that? Let's say you're considering investing $50,000 in a US large cap stock fund. How will that change your the question would be, well, how would that change your overall asset allocation? Right? So whenever you're thinking of purchasing a fund, you want to think about how is this going to further diversify my existing portfolio? How is it going to either increase return or decrease risk, in the context of your overall portfolio? Secondly, you need to look at cost, right? What is the expense ratio of the fund relative to its peers? And also take a look and see what is the share class that you're purchasing. Is it the cheapest possible share class available for that same fund? Third is the portfolio makeup, right? What are the holdings of the fund, right? And you can search this on Morningstar, and how many holdings are in the fund. And the reason that's important is, one, looking at the holdings of the fund, you can get a pretty good sense as to, okay, what is this manager, what are these managers actually holding right now? What are they like? And the number of holdings of the fund is really important, because if you're in an actively managed fund and they own 100 plus securities, 100 plus stocks, it's really hard to see how they're going to be able to outperform the market or take less risk than the market after accounting for the expense ratio. Because, right, once you own 100 securities, you basically are starting to look a lot like, just investing in an index fund. And so what you'd like to see is a little more concentration. We'll talk about this a little bit more, but you'd like to see something that has 20, 30, 40, 50 stocks. Once you get above that, you start to question, what's the point of the active management if you have this many funds? Next, you want to look at performance, and it's relative performance that matters. So you want to look back over 1, 3, 5, and 10-year period, and really with an emphasis on 3 and 5 years. In our opinion, because that's really, we think, far enough back where it's relevant, and also kind of looking forward, 3 to 5 years makes a lot of sense, right? Because it's far enough out that it's not dictated by noise, but it's not so far out that it's like no one really knows what things are going to look like in 10 years. So hard to say. The people, right? Who is the current portfolio manager? How long have they been at the helm? Have there been any changeover in the portfolio managers? Who's the parent company? Another criteria we look at is, does the portfolio manager have skin in the game? Are they eating their own cooking? And you can see how much of their own funds do they have invested in the fund. Okay, that's something that's tracked, and it's, in our opinion, incredibly important that the portfolio manager or managers are heavily invested in the fund that they're managing with their own money, so you can get a better alignment of interests. So when you start to talk about the number of funds, we always want to make sure on this, when we're thinking about kind of the performance, right, and tracking how is this fund done. You want to, it's very important that you're comparing apples to apples. So this starts to get kind of in the weeds here, but basically you can have large cap funds, mid cap funds, and small cap funds. Large cap funds are funds that are purchasing stocks where the market capitalization is greater than 10 billion. And usually it's a lot greater than 10 billion. It's like 20, 30 plus billion and higher, right? Think like Apple, Microsoft of market capitalizations of north of $1 trillion. So there's even a mega cap territory, but large cap stands for large companies. Think of it that way. Mid cap stands for mid-sized companies. So think 2 billion in market cap up to 10 billion. And then small cap is basically 500 million or so up to 2 billion, okay? And you can have large cap, mid cap, small cap funds, both in the US, where they're solely focused on US companies, and or international, right? International large cap, international mid cap, international small cap. And then you can also have a global fund, a global large cap fund that buys US and international companies. And then within each of these, right, you can have what's called a blend, a large cap blend, mid cap blend, small cap blend, or you can be tilted towards growth, or the manager can be tilted towards value. Value, it's really just looking at certain metrics to identify whether the manager is a value manager. But generally, value managers are looking to buy things that are inexpensive, wait till they reach kind of their full price, the market matches the intrinsic value, and then the manager will likely sell it and then find something else that is trading very inexpensively. Conversely, a growth manager is looking more, not so much at how inexpensively the stock is trading relative to their assessment, but more looking at the overall growth trajectory and the profitability of the company and how long they can grow at these kind of above market rates of return. And they're focusing on that pool. So generally speaking, growth managers tend to be more focused in the technology space, and value managers tend to be less focused in that space. But a lot of this stuff, the lines do blur. And so it's not a perfect categorization, but it does give you a sense. And the blend is obviously there's some of the manager does both. Within fixed income, it's even more disparate than within stocks. So these are only some of the different options here. But basically the big categories are US government bonds like treasuries. You can have a mutual fund or ETF for that matter that tracks municipal bonds, right? So bonds issued by states or local governments, mortgage-backed securities, international bonds, preferred stocks. So this is kind of a misnomer. Preferred stocks is really a type of fixed income, even though it's called a stock, where you're getting a set rate of interest from the stock that you purchased. So it's in the capital structure above where the common stockholder would be. Convertible bonds give you the ability to purchase a bond, get some interest, and then convert it into stock at a later time. Investment grade corporate bonds, think, some of the stronger companies with really good balance sheets, good profitability, rated A or better by Moody's and S&P. Investment grade corporate bonds, high yield corporate bonds would be below investment grade, so they're going to tend to have a much higher yield. And then floating rate loans are really like bank loans. Those are a type of fixed income which pay a certain rate, but then there's also like pays 3% plus LIBOR. So, right, if LIBOR goes from 2% up to 4%, now that fixed income security is getting, a 7% yield. So this has been a very good holding so far this year because it's not sensitive. In fact, it benefits from increases in inflation and interest rates. So, these are some of the tools in the toolbox for within fixed income and then within stocks. So hopefully this gives you a sense as to all the different types. But the most important point is if you're comparing, right, a large cap value fund with a mid cap blend fund and drawing conclusions, that's not the way to do it. You want to make sure you're comparing funds that are also in that large cap value space so you can eliminate the noise, right? You want to make sure that the manager that you're measuring the performance of is fishing in the same pond as the manager that you're comparing it to. I think that's really important. It's very easy to make that mistake. Other fund types and terminology, and I touched on some of this. US balance fund. So that doesn't fit neatly into kind of this style box here, but a US balance fund is a very important type of fund to be aware of. It's a fund that invests in US securities, generally large cap stocks, but can also invest in mid cap or held cash or fixed income, all within the same fund. A sector fund is a stock fund that is focused and fishing just in one particular sector. So you can have a healthcare fund, you can have a science and technology fund, right? And they're only focused on that particular sector. Target date funds. A target date fund you'll see mostly in 401k plans, where basically think of it as a fund of funds. So it's one fund that owns 10 to 15 funds within it, and the allocation changes as you get closer to your target retirement date. So if your target retirement date is 2025, that fund has been getting more conservative really since 2015. And then by 2025, it will be fully kind of in a distribution mode. It doesn't mean it won't have any stocks in it. It'll just mean it's much more focused on kind of capital preservation and income. Global funds, a lot of people mistake this for international funds. It's a little different. A global fund generally invests 30 to 40% in US stocks and the remainder in international. Even another fund I just thought of, you can have international funds, but you can have international where it's more developed market, like Japan, the Eurozone, right? Maybe even parts of China now. But then there's also emerging market funds, which are focused on India and parts of Africa, Indonesia, Brazil, places like that. And then alternative funds. Alternative funds are basically any funds that don't invest in any sort of traditional type of asset class. So not as much, pure stocks and bonds, but it's things that track precious metals or commodities or currencies. You could even have alternative funds that have an alternative strategy where they are able to go buy things, that they think will go up, but also sell short things they think will go down. So basically anything that's under the sun, there's a fund for it. Other terminology, just to make sure everyone's clear: active versus passive, right? An active fund means that there is a portfolio manager who is actively making changes to the portfolio, buying and selling things to position it for better risk reward in the future. Passive means, and there's going to be a higher fee as a result of that in active funds. Passive funds, there's no active management. They're just passively tracking a particular sector or index, and so the fees are generally much lower. Most ETFs are passive, although you can have actively managed ETFs, but most are passive. Mutual funds are usually active, except for index mutual funds. And then you can also have, most mutual funds are open-ended, but there are also such a thing as a closed-end mutual fund, which is a mutual fund that essentially trades on an exchange. Sounds a lot like an ETF, and Jeff is going to kind of talk about the differences between a closed-end mutual fund and ETF. Okay, so how does 4J Wealth analyze and use these investment vehicles? So just to give you a little sense. So what we try to do is we start with an outlook for the financial markets, what's going on with the economy, inflation, interest rates, and the overall state of the world, right? Geopolitical risks, things of that nature. We then identify asset classes that we think have the most attractive risk reward ratio, looking out over a 1, 3, and 5 year time frame. So for example, what asset classes, what's an example of an asset class? So an example would be mid-cap stocks, right? Or, starting mid 2020, late 2020, we really liked utilities. So utilities as a sector, that's a sector specific example of an asset class. Or with treasury yields upwards of 4.5% now, treasuries as an asset class can be interesting. We generally use passive funds when we're trying to target a specific sector area of the world. And ETFs provide an inexpensive and very tax efficient way to get that exposure. Again, XLU is the ticker for tracking utility sector. IVV is an index ETF fund to track the S&P 500 index. So just easy ways to track a particular index or sector. ETFs are a very effective way to do that. Mutual funds are used when we believe that the portfolio manager can deliver a return greater than the passive benchmark, looking out over a 3 to 5 year time frame with equal or less risk. And we do think, just as a side note, kind of as the world has evolved over the last 10 months, last year, that good portfolio managers are going to play a much bigger role over the next 3 to 5 years. Active management will play a bigger role over the next 3 to 5 years, because from 2010 to 2020, interest rates were at 0. And so basically, a passive fund could look great, a mutual fund could look great, but now with interest rates at significantly higher levels of inflation, yes, inflation we think will come down, but the whole concept of the Fed just providing easy monetary policy to get us out of any time there was trouble, those days are now gone, right? They don't have that. Now that we have rampant inflation, not rampant, but highest inflation we've seen in 40 years, that is not in their toolbox. And so it's going to be a lot more about which managers can pick the best stocks for the best unit of risk. And so I think you'll start to see some outperformance there from select managers. So then the question is, well, how do you pick the right manager? So this is probably where we spend our most amount of our time, trying to understand the manager's background, their investment process, their philosophy, and their thought process. And a lot of times when you just look on the surface, you could say, well, they're all kind of the same. But when you get a little deeper, when you listen to the calls, read the letters, they're really not. We try to look for portfolio managers that were analysts previously. And the reason is because analysts get into the weeds of the individual companies and really understand what makes them tick. And we think in order to be a good portfolio manager, you need to be really good at evaluating risk reward, but you also need to be able to put on your analyst hat and get into the companies, the guts of the companies, to really understand what's going on. So you need both. But the PMs who start as analysts kind of have that ingrained in them. We also listen to interviews that the portfolio managers, to the extent they have public interviews, read their shareholder letters, and then we monitor the quarterly portfolio changes to see what's driving their decision making. And in addition, we like to know the parent company, right? What is the culture like? What's the turnover? How are these mutual fund how are the portfolio managers compensated? Are they making decisions on their own? Are they getting fed ideas from the analysts that work under them? It's a combination of the two. So a lot of times, at bigger companies, it won't just be that one fund that stands out. It will be that parent company will have a number of funds that tend to do well. And that all comes down to the process and the culture of the parent company. Next, we look at the holdings, right? What are the actual securities that the fund owns? When did they purchase those holdings? And we try to look for patterns in the types of companies the manager selects. We also spend a lot of time thinking about the concentration of holdings and the position sizing, right? You could have a mutual fund manager that owns 60 companies, but their largest stock is 6 or 7% of the fund, right? So that's interesting and can be a good thing. We just want to understand, why they own so many if the biggest one is 6%. Other managers may own 30 companies and they all have the equal weight them at 3% each. Well, there's something going on as to why they do that. Maybe it's a way to control risk. We want to understand that. And then what we really like to do is we like to look for the names of businesses, holdings that they have that we recognize as being outstanding businesses and that not many retail investors would be aware of, right? So they're not as much consumer brand names. They're more names that you wouldn't know of unless you kind of really did some digging. And that's very interesting when we start to see those businesses that not only are retail's not aware of generally, but also that happen to be outstanding businesses that can attract our attention. On the performance front, we look at performance over 1, 3, 5, and 10-year periods, but we're most focused right now on that last 3 to 5 years. And we compare that fund performance over those time frames to the appropriate benchmark, but also to the peers. So we make sure we're comparing apples to apples. We're not comparing a US balanced fund to a US large cap equity fund. We're not comparing a large cap growth fund to a large cap value fund. We also want to look at consistency of performance, right? You can have amazing 5 and 10-year numbers, but if one calendar year you're in the 99th percentile, the next calendar year in the 1 percentile, that's a lot of volatility. And it probably means it could mean there's a lot of turnover as well in the portfolio. Not always, but could be. So we look at that as well. And then we do look at the Morningstar ratings. We look at the fees. What's the expense ratio? How does it compare to its peers? What's the portfolio turnover, right? How often, if the portfolio turnover is 20%, that means they're selling a stock once every 5 years. That's very low turnover. If the portfolio turnover is 100%, that means they're selling, stock every single year. So basically the whole portfolio turns over once a year. That would be very high. And that, if it's at a non-qualified account, that's going to drive a pretty big tax impact from the fund. And then another thing that we're asking more and more on the alignment of interest front is not only do we want to make sure the portfolio manager has a significant stake, their own money in the fund, but we do want to also understand how are the portfolio managers compensated. They almost always have a base salary, and then there's incentive compensation based on the relative fund performance to the benchmark or their peers over a 3 to 5 year period. We want to know that the majority of their compensation is going to be paid based on those 3 to 5 year results. And the best fund companies do it that way: 1 year, 3 year, 5 year, sometimes even 7 year. But you have to ask. You have to ask to make sure, because if they're paid on a 1 year bonus schedule, then they're not going to be looking out. At least they're not going to be incentivized to be looking out longer term when they make these investments. They're going to be incentivized to be looking out only 1 year, which we don't think is as nearly as good a strategy or approach. So let's talk about some of the pros and cons of these vehicles. So pros of the mutual fund, right? With a small amount of money that you're investing, you're getting access to all the underlying holdings. So you have high level of diversification. You get the economies of scale, professional management. So you have a professional money manager overseeing the fund and making the buy and sell decision. They can provide good risk management, and there's a huge range of options that are available with mutual funds. The cons of mutual funds is they can be tax inefficient. They do have a higher cost, especially the active ones. right? You lack control, right? You can't decide or say to mutual, well, I'm okay if you sell that stock, but not that one, right? They're going to do what they're going to do, and it all passes through. And the other con is, there's so many funds out there. It's very easy to own multiple funds and think you're diversified, but you really own the same securities in multiple funds. So there's the risk of those overlapping securities. On ETFs, the pros, again, they can give you very wide diversification. It trades like a stock, low fees, very tax efficient, and a wide range of options. The cons, they usually lack active management. It can be difficult to understand, for sure. Some of the times the complexity around an ETF can create risks. And some ETFs, even though they own a number of securities, if it's a narrow enough focus, like a cybersecurity ETF or some other very specific, it's still not diversified, right? It's not like an ETF that tracks the Dow or the S&P 500, for example. So not all ETFs are created equal, I would say, in terms of their diversification. So asset allocation and diversification, right? So what we're talking about here is portfolio construction, right? Different funds are used to target specific return and risk characteristics. Asset allocation includes using multiple types of asset classes like stocks or bonds, real estate, cash, commodities, with the goal of decreasing the overall risk of the portfolio. One of the biggest misconceptions that we see is people think because they have a lot of funds, that means that they're diversified, and that's not true. Misconception number two is being well diversified takes away all risk. Definitely does not. 2022 is a really good example that unless you basically were non-diversified and had almost everything in energy, you're basically have been hit pretty hard this year, whether it's in bonds, international, US, it hasn't really mattered. Interest rates went up and pretty much everything took a hit. So asset allocation and diversification continue here, then we'll get to questions. So within a broad asset class, you may also have the ability to diversify by choosing select sub-asset classes. So for example, I talked about fixed income broadly, right? Fixed income is an asset class, but within fixed income, floating rate loans have behaved very differently, right, from treasuries in 2022. So treasuries, if you look at like a basket of treasuries from 1 year to 20 years, they're down like 15% year to date. Floating rate loans are basically flat. Within stocks, value has outperformed growth year to date, right? So if you were overweight value relative to growth, you would have outperformed. If you look over the last 3 years, growth still outperformed value. Market has paid a real premium to stocks that yield a dividend. So they've outperformed the general market. Commodities were a very, very valuable asset class to have in 22 as inflation surged. You can also try to achieve diversification by using managers with different investment styles. Some managers may have a more active style where they're not necessarily trying to time the market, but they're consistently looking for where the best relative value is in the market. And they're fishing in, 50, 60, in a pool of 50, 60 companies, but they're increasing weight to the companies with the utility focus, maybe as we're getting, as we're coming out of COVID with valuations so high and no one's excited about utilities. And then now maybe they're decreasing utilities as they've held up better and they're looking to tech. Just as an example, that'd be a more active. Whereas there's other managers that have a huge aversion to selling. And they're just looking for companies that have incredible business economics. We call them long-term compounders, right? Companies that not only have a really strong business model that are very profitable, but they have an ability to reinvest those profits to continue to grow at high rates of return. And really the manager wants to identify those companies, buy in at a reasonable price, and then unless something changes, let those companies go. A very different approach. And then you can also have funds where it's not run by one portfolio manager, but it's run by 6 or 7 portfolio managers, and they're each independently have a sleeve of the portfolio, and they're responsible for just that sleeve. So as I said before, right now we like using managers that are more active because we are in an environment where we have very heightened volatility. We think it's going to be sustained for a while, and that can be taken advantage of for long-term investors. We like the idea of managers being able to increase or decrease stock exposure based on the risk reward dynamic the market is presenting at any given time. We think that's valuable, right? If the market, we're in a bear market. So in a bear market, you can have these really robust rallies of 15, 20%. It doesn't mean that the market's turning around. It just means we're getting a rally. And so to have a manager who can aptly trim in those rallies, but then add when things are down, it makes a lot of sense to us in this type of environment. So, barring the tax consequence. So that ends the presentation part of the webinar. So why don't we go to questions? Jeff, Jamie, I don't know if you've been fielding them, if we have any, but if you want to go ahead, hopefully you're able to chime in here.
Sure. There's one question we have, and that is, what's the difference between a mutual fund and a hedge fund? Do you want to take that one?
You can go ahead and take it.
Okay. So, there's a couple large differences. What we've been talking about today has largely been kind of a pooled investment. So a mutual fund, an ETF, a hedge fund, all that means is basically everybody's kind of funds are kind of commingled together. So that's one similarity. One major difference is with a mutual fund, anybody really can buy those. When you're talking about a hedge fund, the SEC generally wants to see somebody that has a higher net worth, tends to be more sophisticated. Again, that's not always the case, but there can be people that are not good with their money that also have a ton of it. But generally speaking, it's a proxy for people that tend to be more sophisticated. Hedge funds tend to, like Josh was saying, tend to be more focused. You're not going to find a hedge fund that generally holds 300 different stocks. There's going to be a lot more concentration in the holdings. There can be some leverage that's applied there. So that would be another difference that you typically would see. And then also liquidity is a big issue. So for ETFs and mutual funds, you can kind of get in and out the same day. For ETFs, mutual funds, you just sell at the end of the day. Usually there's a lockup with respect to hedge funds. And so, you might be able to get a portion of your assets out each quarter. And then there's also a performance type of fee that's kind of generally applied, as opposed to kind of just let's say it's 50 basis points or 0.5% or 1% for the manager on an annualized basis. Typically, hedge funds will be 1.5% to 2% plus 20% of the profits over a high water mark, something like that. So there's a lot of differences there. And hopefully that helps to answer that question.
That was great, Jeff. I would add in two more things. One is a lot of hedge funds are going to be long and short. You can have long only hedge funds, but generally they're long short, which means that they can basically sell a stock or an entire ETF, right? They can short parts of the market and they will make money as things go down, or can make money when things go down by shorting. And the other thing about hedge funds is they can invest in things that are very exotic, right? They can buy artwork. They can, Michael Burry ran a hedge fund back in, during the housing crash in 07. I think, was it Scion then, Jeff? Is that the name of it?
Yes.
And he literally went to the investment banks and had credit default swaps written up. He literally, and then, you're just never going to find that with a mutual fund. So you can get into much more exotic type things with a hedge fund that you can't get into mutual funds. But the reality is, it's one of those things where the hedge fund manager generally makes a ton of money, but the ones that are really successful are few and far between over the long term. A lot of them blow up.
Yeah, I mean, what you're talking about was the great financial crisis, that whole period and the Big Short. And a lot of those hedge fund managers really nailed that whole housing blow up, but then subsequently struggled.
Right.
So you're kind of, there's very few, just the same way with active managers on mutual funds, most people tend to underperform over the long period, but there's always going to be a Warren Buffett out there, a Michael Burry, David Tepper from Appaloosa. So there are the legends of Wall Street for sure, but most hedge funds probably tend to underperform, just a passive index.
And one thing that Jeff and I do look at, and maybe Jeff, you can talk about long-term capital management back in '98, because when you have a big hedge fund and they're very focused on one particular area and it unwinds on them, it can create dislocations in the financial markets.
Yeah, that's right. That's right. Well, long-term capital management was based essentially, it was a bunch of PhDs that kind of got together and put together a quant strategy for how to arbitrage, I think, emerging market currencies. And essentially what happened is the strategy became so one-sided that when things kind of moved the other way, they blew up entirely. And then
these were supposedly the smartest, people on Wall Street that all were. That's what I think it happened in '98.
Yes, that's right. That's right.
So anyway, we went into a lot of detail there, but hopefully that gives you a sense. What it looks like we have more questions coming in.
Yeah. So the next question is, what is the difference between closed-end funds and ETFs, and why do closed-end funds trade at a discount to net asset value? So I can take that one too, if you'd like. This kind of gets in the weeds a little bit. Closed-end funds are similar to ETFs in the sense that they trade on an exchange, just like an exchange-traded fund throughout the day. So you can buy and sell them throughout the day, as opposed to a mutual fund, which is prices at the end of the day, obviously. So the difference between closed-end funds and ETFs or open-end ETFs is the fact that if I, as an institutional investor, want to buy an S&P 500 fund, I can go to basically a bank and say, create me new units of this ETF. And so now the share quantity of that ETF will increase. And when I redeem, they can basically do the opposite. With closed-end funds, there's a set quantity of shares from the very beginning of that existence of that closed-end fund, and it will never change. They will never create more units, and they will never reduce the amount of units available. And so what happens in that sort of dynamic is that closed-end funds can now trade, if there's a lot of demand for that, it will trade in excess or at a premium of the underlying securities, or it can trade at a discount if there's a ton of pessimism. We see this a lot. There's a lot of municipal bond ETFs that apply leverage, or I'm sorry, closed-end funds that apply leverage. And oftentimes in a market like this, where we're seeing rising interest rates and bond holdings are getting hit pretty hard, you'll see a lot of these closed-end funds trade at a discount. So what that means is basically, if I had a bucket full of these bonds in the secondary market, they should be trading at, let's say, $100. They might be trading at 90. And so you're basically be able to buy $1 for 90 cents. But the problem is, when does that gap close? Does it take you 5 years? Does it take you 2 months? Is there a liquidity issue that's driving that discount? Sometimes it can be the result of, 3 or 4 stocks in that closed-end fund. Is really concentrated closed-end fund that's held essentially by a couple investors. And so you're really just never going to close that discount or premium gap to net asset value. Hopefully that helps. Next question is, how will AI in the future eliminate the emotion or bias a fund manager may have? And more basically, can AI replace them? It's a good question.
Yeah.
You have any thoughts?
Um, so my cousin actually is a machine learning data scientist, and I was actually talking to him last night, and he said that his opinion on this, and he's a math PhD, so he would know AI as well as anyone I know, is basically that while machine learning and AI is going to change the world, it still right now is in very early stages. And his joke was that, well, we could be applying it to really important things. We're applying it to how to get someone to click more on the cute pictures of cats, on social media. So that's where it's being applied right now. He said where it's really had a lot of value add is on the foreign language translation. So if you go to like Google Translate and you put in words, if you say something, it might not get it exactly right to translate into Spanish or Portuguese, but it will get it where the person knows at least what you're talking about. There's a possibility that to the extent AI and machine learning, there are funds out there that use AI to pick stocks. It hasn't done very well. If it gets to the point where it's replacing portfolio managers, my guess is it's also at a place where it's replacing a huge number of jobs in the overall economy. But I don't have any sort of special knowledge to say, that AI is going to replace managers. Certainly a lot of people are thinking about that. But I don't know if it will happen or frankly when it will happen. My guess is it will happen much slower though than people think. That's my gut. It's just hard to imagine, because ultimately, unless AI just takes over, the market is still driven by humans, and human beings are not going to ever be able to divorce themselves totally from the fear and greed. And fear and greed, for as long as the market's been around, there's as much relevance with fear and greed today as there was 100 years ago. And even with the AI, maybe it helps to moderate that, maybe it doesn't. I still think that you're going to have those swings in the market as a result of those emotions. I don't have a great answer. It's a good question.
Yeah, that's a tough one. The next question is, are there funds focused on futures and options?
So in other words, is the question saying, are there mutual funds that just invest in like stock options, or
It just says funds. It's a little ambiguous if it's mutual funds or just,
I'm sure there are, and I know there's definitely funds that use futures in them, but it's very few and far between. But there definitely are ETFs that you can buy, which essentially either they generate income as a result of selling puts or selling calls, things like that nature. So it's option related. But I guess it would. The question is why would you want to do that? Would it just be a way to kind of put a small amount of money in to get a lot of leverage, or there are funds that do it, I guess is this short answer to the question, but they're few and far between. I don't know, Jeff, if you have any more insight there.
Yeah, typically where you'll see a lot of futures being used are on the commodity side.
Right.
Because if you think about it, if you wanted to have exposure to oil, a mutual fund or an ETF is not literally going to buy oil and take delivery of it and have it sit in a warehouse. What they're going to basically do, what investors really end up wanting, is kind of the exposure via the futures markets. And so in commodities, you'll see, if you kind of look and dive deep into the holdings, you'll see a bunch of cash. It'll be like 95% treasury bills or collateral. And then, the futures exposure, 100% of the exposure of the commodity is via futures. So that's typically where we see it. But Josh is right. Some funds or ETFs will have an options overlay, similar, using options to kind of maybe put a floor in some sort of exposure to the S&P 500, for example, or sell calls to generate additional income, that sort of thing.
Yeah, I was going to say definitely probably the most frequent where we see options being used, at least in the funds we're doing, is where they're writing covered calls. So right, they're taking certain positions they have, and then they're selling calls to generate income, and basically saying that this value, if the stock got to the side and this got called away, I'm okay. I would be okay selling it there. And if it doesn't, I've generated extra income for the shareholders. These are really good questions. Challenging. Any other questions? I know we're over time, but if anyone has any other questions they want to ask, we're happy to address them. If not, that's great too. Thank you so much. Hopefully this was enjoyable and you got out what you thought you would get out of it. And if you want to send us an email, follow-up questions, we're more than happy to answer them. So until next time, have a good rest of your October and November. See you soon. Bye-bye.